There are two key investment strategies: active and passive fund management.
Welcome back to the fund management series on Atlas Crossings.
Active fund managers embark on a quest to achieve a positive alpha, signaling their pursuit of outperforming the market. While they acknowledge the challenge of consistently beating the market, they believe in exploiting unsystematic risk and mispricings to generate excess returns. Their playbook involves active trading, buying and selling assets based on their assessment of market conditions. The success of active managers hinges on their ability to make strategic decisions, identifying opportunities to be overweight in strongly performing assets and to be underweight in those that are weaker relative to the benchmark. It's a high-stakes game where success is celebrated, but failure to outperform the market can be a stark reality. In contrast, passive fund managers adopt a more rule-based approach. Their primary goal is to mirror the market rather than actively seeking positive alpha. They achieve this by replicating a specific market index or benchmark. This strategy eliminates the need for constant trading and relies on the belief that over the long term, the market's overall growth will translate into satisfactory returns. Passive managers often engage in buy and hold strategies, minimizing transaction costs and capitalizing on the broader market's upward trajectory. While they may not outshine the market, their aim is to provide investors with consistent market-aligned returns. Each investment strategy has its merits and risk, and investors often choose based on their risk tolerance, investment goals, and belief in the efficacy of active decision-making versus passive replication. An active manager sees the potential to beat the market as an achievable exploit, fueled by their skills and their ability to conduct in-depth research. Their confidence lies in the belief that by identifying good opportunities and avoiding pitfalls through active decision making, they can secure excess returns for their investors. However, the significant challenge here is the statistical reality that the majority of active managers actually underperform the market average. This creates a dilemma for investors: how to identify the minority of active managers who can consistently outperform. On the other hand, a passive manager adopts a more restrained approach, avoiding the pursuit of beating the market on the grounds that it's an elusive goal to achieve consistently. Instead, they focus on mirroring the market, aiming to minimize transaction costs and steer clear of potentially poor active decisions. The challenge here arises if the market is not entirely efficient. If anomalies persist, matching the market might not yield optimal returns. There is an efficiency dilemma here. The efficient market hypothesis posits that markets are efficient and all information is quickly reflected in prices. Passive managers benefit from this by aligning with the market. However, if the market is not entirely efficient and anomalies persist, it introduces a dilemma. While passive managers thrive on market efficiency, they rely on active managers to identify and eliminate these anomalies that might exist, ensuring a more efficient market overall. A more modern approach has emerged to address the ongoing debate between active and passive fund management strategies. This is known as the core satellite investment approach. The core satellite investment approach is gaining popularity in the investment landscape. The fundamental idea behind this strategy involves dividing a portfolio into two distinct segments. One segment is dedicated to the core strategy, emphasizing investment in cost-effective, diversified index funds. This portion of the portfolio is intended to remain relatively stable, avoiding frequent trading, and is consistently augmented through contributions to a workplace retirement plan or another systematic investing program. The second segment involves the satellite strategy, providing investors with the flexibility to overweight specific sectors, regions, or styles. This allows them to capitalize on current economic and market conditions, potentially generating significant returns. This actively managed part of the portfolio enables investors to tilt their investments to outperform the market without exposing themselves to excessive risk. A fund using the core satellite investment strategy can allocate the majority of funds to an index, for example, S&P 500 or FTSE 100, and invest in other assets with higher levels of risk and or a more active investment approach. In essence, the core satellite approach strategically focuses on long-term wealth creation while offering the opportunity to enhance performance by adjusting the portfolio based on prevailing market dynamics.
Thank you for watching, and don't forget to continue to show up.